Welcome back to Indianomics and to our special discussion on global growth and the commodities supercycle. Is it headed much lower? We just spoke to Sanjeev Sanyal of Deutsche Bank. We now have another prominent economist from Morgan Stanley. I'm being joined by Manoj Pradhan. Good morning, Manoj. Thank you very much for joining us. Well, first up, let me start with the same question I started for Sanjeev. Do you think that this growth scare that we are seeing in the global economy is warranted? IMF's 3.3%, is there a danger of it getting scaled down even further?
I think there's an element of expectations not being met. So what we have seen is when the IMF numbers have come off relative to our recent forecast numbers, almost everywhere, universally across developed and emerging markets, their downgrade still remains above the numbers that we had as our base case. So I think what that's telling us that the reaction to that downgrade, given how pronounced it has been, tells us that investor expectations about growth might have been a little too strong. And those are getting scaled back, and so hence in the minds of investors, the lofty numbers that they had are probably not being achieved, and that's giving them some cause for concern.
Okay, where exactly is the growth concern emerging? Is it in the US itself? Because the latest factory output data and jobless claims came in stronger. So is it US or is it China? Where is the growth scare?
I think the growth scare has been primarily concentrated on the very sharp drop that we saw in the numbers in Germany, which has been something that people have paid a lot of attention to. One of the other parts of the world that is worrying people a lot is the property market in China. Right? Besides that, I think what is happening is that we are seeing signs, as we always do, that the world is interconnected. And so when US growth remains strong, and that points to an exit from monetary policy for the Federal Reserve that may be a little sooner than many had expected, that leads to stronger, say, perhaps the US dollar. And something that we've been worried about is that there's been an export of deflation that many policymakers have tried, and with the dollar rising, it gives the US the role of becoming the sink in some senses. So when the dollar rises stronger, it ends up importing more deflation than it would perhaps have liked. And hence that scales down people's expectations of how quickly the economy can recover to what they call a normal level.
Which explains the big shudder in financial markets. I'll come to this point yet again and how the Fed is likely to respond. But first, the commodity markets. I mean, there as well, we have seen a 10% fall in the general commodity, Reuters or Bloomberg commodity indices from recent highs, and commodities like crude getting into bear market. I mean, 20-30% lower from recent highs. So is the commodity cycle likely to see even further softness? Because according to you, the growth could be even lower than IMF.
Right. I mean, look, there are three parts to a commodity story, right? The very near-term story economists are not very good at talking about. So let me give you the structural backdrop the way we see it. The first is the large consumption of commodities has primarily come from emerging markets. And that slowdown, as we've been discussing for a while, we've been talking about this for, what, two and a half years now, that story is still unfolding according to us. So if the downside risks structurally to emerging markets still remain in place, then the downside to demand for commodities will remain in place, right? The second point is there is some, rather than calling it offshoring, there is some change in the way developed markets are growing and that they're producing more at home themselves. Right? And if that's the case, then developed markets tend to be more efficient in the use of commodities for two reasons. Number one, they have very high labor costs. So they have to be very, very conservative on how they use all other inputs. Second thing is they don't need infrastructure. Right? The emerging markets guys need infrastructure. So structurally speaking, there is a shift away from demand. In the meantime, over the last 5 years of very high commodity prices, there has been a structural increase in the supply because of more production getting online. So I think we are seeing these dynamics play out. Most recently, it's the growth scare that I think is putting a significant downspin on commodities.
Okay, one more word on commodities before we get back to other parameters. Do you see 2015 also as a year of soft commodities? That will depend on your idea of how much growth recovers as well in 2000.
No, it's very true, and where growth recovers, I think, is most important. So we are not expecting to see a large uptick in growth that's coming out of emerging markets. The second thing we are also expecting is that where the U.S. story remains resilient is where the energy story is playing a large role. And that energy story playing a large role turns the US into a manufacturer of sorts. And so if more of the production is coming, as I said, from the developed market side, you don't see a large uptick. Now, bounces in commodities that come off scares like this, those are things that no one should rule out. But the structural price change, at least, is not something we should factor in for 2015.
Okay, softness through 2015. Now let me come back to the growth dynamics, to the United States. What are the chances of a rate hike in 2015? Will it still happen, but not in mid-2015?
Well, our expectation is that the Fed does not hike in 2015. We think it hikes in 2016, early 2016, precisely because of these dynamics. As the U.S. economy shows resilience, or it shows continued strength, not massive amounts, but just on an upward trajectory, markets start thinking about this, right? They start pricing in either a June hike or a hike in the second half of the year, and that leads to the dollar or the 10-year, or perhaps both, rising a little bit faster than the U.S. economy can handle. Once that happens, as we've seen in the recent past, you get a pullback. Now, we have something very interesting from our strategy team called months to the first interest rate hike. What we've seen in the last few weeks from them, from that metric, is that the markets do seem to have pushed the first interest rate hike 2 months further into the second half of 2015.
Okay, so your sense is that next year you might, where might you see bond yields in the United States? I mean, it fell sub 2. Same time next year, are yields likely to be closer to 3% because you're smelling the rate hike?
In our view, I don't think they'll go that far. But the economics behind it at least suggests, look, that there are two ways to think about this. Being an economist, we have to present both. The first side is, your standard story. The U.S. economy is better. You're getting closer to a hike. People start pricing in a series of hikes. And that's what leads the 2-year and eventually slowly the 10-year. The 2 years where I think most of the stress lies in the market, and the dollar moves along somewhat with that. Now, there's another element to that. So some of our teams have also pointed out that, look, what has changed about the dollar is that it looks a little bit less like a funding currency now, and it looks a little bit more like an investment currency. So if it is now attracting investment flows, then you have a bid for the dollar, but that keeps perhaps the interest rates from rising very aggressively. So you have to think about that both those combinations are open. In our view, a steady rise in the currency value, a steady rise in the interest rate will not bother the Fed too much. If it becomes aggressive, then I think that unsettles them.
Okay, anything too much too fast is going to unsettle them and push up timetables.
That's right.
Now, finally, how do you look at India in the whole picture? Your world view is that commodities are not going to get very expensive. Neither is global capital going to get very expensive. So is this going to be a sweet spot for India? What's your estimate?
I mean, look, this is the world trying to use automatic stabilizers to its own advantage. Whenever things go out of kilter, there are many things that we call automatic stabilizers. Commodity prices are one of them, interest rates are another, currencies are the third. These always tend to stabilize and play off the economy so that it doesn't go out of whack too much. Now, as far as India is concerned, we believe it has turned the corner. After last December, we had become more constructive on it. Obviously, after the set of reforms that we've seen over here and the way India's dynamics seem to be shaping out, one point that we had made is, given that India has not an over-allocation of capital problem, but an under-allocation of capital, which is easier to fix. The fact that when you add capital to improving demographics, you get a production function which is charged on all fronts, and the fact that you have low-hanging fruit, which my colleague Chetan Iyer has been talking about a lot, you put that combination together, it's not that hard to revive growth in India, but it's one of the few places here. And what we see working for it is the fact that you are able to use these conditions to your advantage. Now, when US interest rates start rising, I continue to believe that emerging markets will have to face a fair share of their burden with rising real rates, with the currency that tends to become a little difficult to manage. But India has done quite well. So whether it's from a cyclical point of view, whether it's from a structural point of view, it does look like it's at a comfortable pace. Of course, the two caveats always are, a disruptive global mechanism is not something that India is immune from by any standards. And the second thing is, even these thresholds that we are saying are relatively lower because of India's low per capita GDP, even those have to be met. So you do have to exceed the bar that has been set in order to actually realize the growth that's coming. But as far as we can see, it looks like over a 5-year horizon, it's on a good course.
Oh yes, what India does with its own raw material of population, demographics and resources remains one of the key determinants of growth. But the global environment is largely likely to be clement to India. Is that the point?
I think that is the point. And you know, credit to India's policymakers, they have dragged themselves out of a precarious situation. So if you looked at them last summer, it wasn't rosy at all. They were very much on the back foot along with Brazil, with South Africa, Turkey and Indonesia. And they were in a club of the 5 most exposed economies. Come end of last year, we had already argued that they have done a lot to get out of that club. Okay, so they are in a much more resilient position. The cyclical situation helps them, but exactly as you say, what they do with their own destiny is really up to them.
Absolutely. Thank you very much, Manoj Pradhan, for taking us through your worldview of what the economy, interest rates and commodities might do in 2015. Well, that's the sum and substance from 2 very important global voices, 2 very prominent, well-respected economists that you know, they're divergent in terms of what they expect in terms of global growth, but both of them expect a soft commodity cycle to prevail through 2015, capital to remain largely cheaper, interest rates not running away in the United States, and that presenting a fairly positive world environment, world ambience for India. If we still mess up on growth, we can't blame the world for it. That's the short story. Thanks for watching this edition of Indianomics.